today is our first podcast of the year, and it is Thursday, January 30th, 2025. We're starting off the year right. Things are looking good, and we're going to cover a lot of things, as always. Of course, we just had a Federal Reserve meeting yesterday, and kind of a bit of a yawn, but they did do a pause, and Dryden's going to cover that in a little while. And then we're going to, of course, talk about the market. What do we see? What do we like? And then there's just some other tax law changes that are already in effect this year, even before the potential changes. So I'll talk about that. And President Trump is definitely talking about deregulation, and we'll get an opinion of why is that important and is it really going to happen. And so with that, there's a bunch of other things that we'll be talking about as we go, and I will just get started because, like I said, we did have a meeting yesterday, and they basically did exactly what was expected, and nothing. They expected to keep interest rate the same, and they kept it the same, even though President Trump would like to see lower rates, but right now the data is not supporting it. So, Dryden, can you please tell us what happened yesterday and why did the Fed pause? And also, what do we expect as far as this year looking, since we already have a pause this year as far as interest rates?
Well, I think pause is the operative word, and we've been talking about this for a long time. The fundamentals of the economy are still strong, and you're seeing that we were able to pull inflation down from a very high rate to a sustainable rate. The economy has now moved into a positive and sustainable growth rate of mid twos, and so I think where we are with the Fed is they're most fearful of reigniting inflation, because inflation is the thing that actually erodes purchasing power. It's also the biggest political event. So because of that, they're going to be in a position where they probably pause. Now, folks, it's important to realize we were paused at 550 for an entire year. And now we've lowered interest rates by a full 1%, by roughly 20%. And so if you move from 550 to 450, that is a significant move. And I think where we stand is we may be paused here, or we could be paused here for a year. We don't expect a interest rate cut until June at the earliest. You could see maybe a quarter point in June, maybe a quarter point closer to the end of the year. But I think we also have to be prepared for the fact that the economy is resilient, it's strong. You have a pro-growth administration, and because of that, you could be paused at 450 for an entire year. And which is why, from the investment team standpoint, we've been keeping our duration short. We've been keeping at the short end of the curve.
You mean bonds?
It's not of the bonds, yes, of the bonds, because it's just not worth the risk of moving out. Right at this point, the yield curve is flat, slightly elevated, slightly normalized. But trying to go way out on the yield curve, or trying to extend duration, is just really not worth the risk. So we're keeping on the short end. We think that the Fed's going to they're probably paused for at least 6 months.
We're getting pretty good yield, right?
Over 4%. Over 4%. And they're paused for at least 6 months. We don't see a move before. Something really surprising would have to happen for them to try to move before June. And then it may be we're data dependent. We drop it by a quarter of a point and then wait again. So I've said this now for almost 2 years, and that is that those who expect interest rates to fall precipitously, or us to be back down in the 2s or even 3s anytime soon, are going to be woefully disappointed. But higher interest rates, or paused interest rates, or interest rates at 4.5%, because the economy is strong, is not a bad thing. It's not a bad thing. And we've been able to be sustainable with a growing economy at these rates for a long period of time. So I think that we sort of have to kind of get used to the fact that further rate cuts from here are going to be very muted.
We just had a GDP today. And can you comment on that, and also comment on unemployment?
Well, GDP, I mean, you did the revisions on the third quarter. It came in a little lower. You're around 2.3. But I mean, the point is is that all these numbers are subject to revisions a bunch of times. And, you know, we also look at the fact that, you know, for the jobs data, we have a very strong jobs market. You know, when you see a tick in the unemployment rate, it's usually because you have more job entrants, you have more labor force participation, more people looking. So really what I focus on are the number of people working, and the number of people working are at an all-time high. And so you try to turn the noise off in these daily, weekly, monthly numbers, and recognize that from an aggregate demand standpoint, which is total demand, goods and services in the economy, you know, we have the consumers are making money and they're spending it, and that's why we continue to have a robust economy. You know, typically this fourth quarter number was led by consumer spending, and I think that continues on to be the driving factor of the economy. It doesn't look like it's slowing down.
So how do you think, you know, when President Trump talks about getting inflation down, how do you think he's going to do that?
Well, there's a couple of levers to pull. The biggest one you're going to pull that people are going to react to is, and they try to leave it out of certain things, is going to be energy costs. I mean, the two most recognizable prices in America are your mortgage rate and what you pay for gasoline. We've already decided that the mortgage rates are going to be sticky, and that the Fed will maintain some of its independence, and probably that's not going to move a lot. You see the back half of the year, you could see energy prices, you know, as you talk about increasing oil production, you could see oil prices come down a little bit. And that would be one way that they do it. The other way that they're going to fight inflation is we're kind of balanced in the labor market right now. We're about 1.2 jobs for every person looking. And so you don't have a lot of wage push inflation. And while some people talk about tariffs being inflationary, if you really get into the math about it and realize that these things are going to be focused and not across the board, there really doesn't seem to be a lot of well, a little jawbone it and say it's inflationary, but it's probably not going to be. Could be for one or two product lines or components. But not inflationary across the entire economy. So what the president can do more than anything else to bring down inflation is to promote things that increase labor productivity. The solution to inflation, the permanent solution to inflation, is increased labor productivity. And so things that make labor more productive will drive down prices. It's just like when you first put a computer inside a cash register, when you first started using computers. So I think we're actually going to see, as we adopt AI, as we adopt all of these things across the board, you're going to see that lower prices because it's going to make things far more efficient. And the other thing is government spending. You know, they seem to be serious about trying to bend the curve on government spending. Government spending is typically more inflationary than private sector spending. It has different multiplier effects. It has different ways it works through the economy. So when you begin to see government spending go up, that tends to be more inflationary really than what you would normally see in consumer spending due to how it works its way through the economy. So if they're going to cut government spending in certain ways, that will take some inflationary pressure off of it as well.
So, you know, clients talk to me all the time and they say, well, you know, what do we think of the market and what's going to happen with administration and so forth? And I constantly go over the fact that what we look at is earnings. What drives values of the market is earnings. And so talk a little bit about how do you see the market this year and how do you see earnings and the data that we've looked at. And I know we just sent out a great newsletter. I hope all of you read that. It was very well done by our team. And they actually go through the risk and the rewards and the pros and cons, and they go through even companies by company. So I implore you, for those of you who have not read it, I know it's a lot more fun to watch us speak, but if you want details and you're an engineer or want to see data, really read our newsletter. We just sent it out yesterday. And if you haven't received it, just email us or call the office and we'll make sure we get it.
And kudos
should have got
to,
it.
yeah, kudos to Ian Vincent on our team. He tends to be the lead on that document. So very well done this one. But I think a couple of things to pay attention to. I am far more interested in bottom lines than I am headlines.
That's the
And
point.
so headline news will bounce the market around, things will be volatile. I'm interested in the bottom line. And what we see is very strong continued increases in earnings growth for the rest of the market. I've talked about this a dozen times. Last year you had most of the market was propelled by the earnings of really 5 companies or 7 companies. And that comprised a lot of that, kind of pushed the indexes, it pushed the NASDAQ, pushed the S&P 500. But what you're seeing now is a broadening out of effective earnings growth. And so it's the rest of the S&P 500, the big 493, if you will, that are continuing to see substantial earnings growth. And that earnings growth is going to be what's going to propel the individual stocks and the markets forward. And if you take a look at what we see in the future, earnings for 2025 are estimated to be probably 13-14% higher than they were in 2024. So you have that number, right? So if you keep the multiple constant and the earnings go up by 13%, well, your stock market goes up by 13%. If you take a look at statistically, in the first year of a presidential administration, the market goes up by roughly 13%. In the first year of the second term of a president, goes up by 9.7%. So you have to kind of ask yourself on that statistic, are we in the first year of the second term of Trump, or are we once again back in the first year of what is a first-term president? We didn't have data when this happened with Grover Cleveland. But I think the important thing to look at is if you want to go, gee, what's looks like for the market, I think you have a high probability of it being high single digit, low double digit market. Earnings are going to grow about 13%. The stock market probably ought to grow about 13%. I don't think we're going to see a third year of a 20% market, but I think we're probably going to see one that's going to be reasonably positive in this level.
So what are the risks?
The risk. The risk are periods of overreaction.
Like DeepSeek.
Like the DeepSeek thing you saw. We can come back to that in a little bit. The risk are periods of overreaction. So you're going to see these moments where everybody's a frazzled cat, where they're looking for a reason for everything to go silly. And so the market will react. And then cooler heads prevail. They go back and kind of look at it and go, at the end, it's really all about earnings. So always there's a geopolitical factor out there. Could there be geopolitical risk? You're actually seeing some of that settle down. We're finally talking about, there'll be a lot of posturing, but you probably get a solution in the Ukraine. We're talking, you're probably going to get some things settled down in the Middle East. So you don't know where the next hot spot is going to be. But again, as I've said a couple of times, geopolitical risk has about a 45-day, turnaround. So those are the biggest problems. People talk about tariffs. I want to spend a second on this. You have to begin to look at tariffs a little different. First of all, a tariff is a sanction that inures an economic benefit to the sanctionor. When you try to do sanctions writ large and you get 25 countries to put sanctions on somebody who's a bad actor, inevitably you get people that cheat. And they're not as effective. But when you want to do a tariff, you can do a tariff against a very specific country, a very specific thing. You could do a tariff on stuff from an individual company if you wanted to, or an individual product line. And so what has happened and what's different is the president tends to talk about, well, we'll put 25% tariffs on everything. But we've seen this before, right? In his first administration, they said that. And then the next thing you know, it's only on a couple of things, right? They're going to negotiate down to what really matters. But I will say this. The president has found his weapon system. he's found a weapon system that he can unilaterally use without a lot of interference
Kind of like
from
what he did in
Congress.
Colombia.
Yeah, exactly. I'm getting there. Without a lot of interference from Congress, or he doesn't have to hold hearings, and he doesn't need a whole bunch of other stuff, and he doesn't have to call out the military. So you saw this against Colombia when, okay, he's found his weapon system, and the other side capitulated pretty quick. And so I think you're going to hear a lot more about him going, well, you're either going to fall into line, or I'm going to put a tariff on this, 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 and this. And he can do that quickly, and he can do that without a lot of interference from a lot of people. So he's found his weapon that he wants to use. And the point of the matter is, he's proven that he will use it. He can be effective in using it. And more importantly, it's probably a cheap way of warfare if you want to have that. And I think that when you recognize that in most cases, they need us more than we need them. We have what's called consumer power. We're everybody's biggest customer. And when your biggest customer wants a discount, you tend to give it to them. So I think we're going to see this. But what I want to caution everybody about is, here's what's going to happen. This tariff talk is going to create headline volatility. There'll be overreactions. He'll say something about a company, and all of a sudden everything in that sector will get crazy. The important thing to do is recognize, step away, don't panic.
That's our job, right?
Take a look. That's our job. We'll assess whether it matters or not. And in most cases, it doesn't. And if you give this stuff a couple of days, it settles down. We'll probably find ourselves throughout this year in a position where we're going to take advantage of volatility and not be its victim.
All right, I'm going to change subject a little bit, because there's a couple of things that are already in effect this year with regard to taxes that I need to make people are aware of. First of all, one very important thing, okay, the regular 401k for people, 401k, 450, 403b, 457, the elective contribution that you can make right now if you're under 50 is 23,500. If you're over 50, it's 7,500. So now the total, if you're between 50 and 60, you can put 31,000. But starting this year, and for the very first time, there's an additional catch-up provision for people who are age 60 to 63. So if you're 60, 61, 62, and 63, only this time, only those people in those 4 years get to put an extra $4,000. So the catch-up provision, if you are 60, between 60 and 63, you're now able to put in your 401k $41,500, which is a big increase. And you really need to make sure and elect that and make sure it is done in your payroll, because it is so new. Some of the systems don't accommodate them. If you just put that you want to have the catch up, you won't get that extra 4,000, because you need to manually or make sure and call your HR and get that, because it's just a great benefit. And they're only allowing people in that age group to do it because they feel that those are the age group that are going to be retiring soon, and they're giving us an extra $4,000 to put for those people. So it's a wonderful thing to do. Also, the annual gift this year, if you want to give to your children or grandchildren or anyone, it is 19,000. It's up from 18. So if there's 2 of you, you can give 38,000 to anybody, and not have to file a gift tax return to do so. And the gift tax exclusion this year, it's at basically 13,990,000. So it's almost 14 million. So you and your spouse can do 28 million basically estate tax free. And that's of course subject to, we are going to have a big tax law changes that have to happen. It's estimated that trying to work on it to have it done by the end of March or early April, as far as the changes, whether they're going to keep these current tax laws that we have, that were the Trump tax laws that are supposed to expire at the end of the year. He's not going to let that happen. But in addition to that, we anticipate 3 more changes to the tax law, a few more changes that affect most of you. He promised to eliminate taxes on Social Security. That would be huge. There's 69 million people in the United States that receive Social Security. If you think maybe 30 million of them at least pay taxes on their Social Security, having that money in their pockets, that would certainly help spending and will help the economy. And because, as you know, the GDP is all about consumer spending. So anytime you give people more money in their pocket to spend, they will. And there's 30 million people that want to spend more if you give them the tax money. And of course, the other thing he promises to not have taxes on tips or overtime, and propose having auto loan interest expense as an itemized deduction. And of course, the SALT deduction, it's promised to expand. I know Dryden has been talking to several congressmen, and that is a big topic in Congress right now, which would allow itemized deductions to come back in place, especially in California, where we could be possibly able to deduct more of the state income tax and property taxes. And then increasing the child tax credit from 2,000 to 5,000. So there's a lot of tax law changes, and hopefully all these, that law would pass by our luncheon date, which is April 26th, Saturday, April 26th at the Hyatt Hotel in Irvine. You should have all received a save the date. And if you haven't, call our office. That means there's something wrong. You're not on the mailing list or something like that. So if you please put that on your calendar from now, and think about inviting your friends, your relatives, your children, anybody who thinks it's going to be an amazing luncheon, because we're going to talk about, we call it is our State of the Union address. It'll be our 29th luncheon. We'll be talking all about the markets, what happened last year, what's going to happen this year, all the tax law changes, and all the planning you can do. So mark it from now and tell your friends. Okay, I'm going to turn it back to a subject that kind of rattled the market a few days ago, which is what happened with this DeepSeek, a thing that came on that rattled the tech stocks. So I want Dryden to tell us a bit more, what is DeepSeek, and really what to expect, and what do you think from there, Dryden?
Sure. Well, I mean, one great caveat I will give to this is I'm always suspect of anything coming out of China. If they have talked about their data or their information, what happened was DeepSeek comes out and says, "Hey, we've got something that's just as good, if not better than ChatGPT, and it does so a lot less expensive." But you really don't know for sure if the numbers that they're using are accurate numbers, because they're going to fudge them. And so that's the first thing. The second thing is, this is part of the AI revolution, not all of the AI revolution. The idea was, oh, well, if you can do it a whole lot cheaper, maybe we don't need as many chips, maybe we don't need the same thing, maybe it's breaking down the NVIDIA circumstance. But I think the important thing to recognize is that even if everything they say about DeepSeek is true, it isn't the end of AI as we know it. It's not the end of the chip revolution and necessity as we know it, because realistically, and I've said this before, you have to look at two different things. When we talk about AI, there's infrastructure and there's implementation. And right now, a lot of money is being spent on infrastructure. It's like building the Transcontinental Railroad. We're just laying the tracks, right? For the data centers, for all the chips that are necessary to make this work, for the storage that it's going to take. We produce 5 times more data now on a daily basis than we did in 2019. So when you think about all of that, what this means is that the infrastructure build out may slow down a little bit. But it doesn't mean that it's over, nor does it mean that it's not going to happen, nor does it mean that it's not a necessity, right? This is one of those headline things that have yet to play out in bottom lines. And so I think that it's important to recognize that. The second thing is, what's most important to recognize about the AI revolution is that the real profits long-term begin to come from the companies that begin to implement utilization of AI and increase labor productivity, and thus increase their profit margins. So we're only on the very early stages of that. So what your investment team is working very hard to do always is we're looking for not only the revolution of AI, but the revolution of what we call AI plus H, the AI plus the human factor, and who's using it most effectively to increase labor productivity and profit margins. So this thing has one company coming out with one thing that may be a little cheaper, and we can't even verify that, doesn't derail what we think is one of the biggest tidal waves of themes in the economy for the next decade. This is, so I think that we just recognize this is a headline moment that has yet to show up in bottom lines, and we take advantage of volatility and not be its victim.
Very good. So because potentially, like you said earlier, the way to get inflation down is to use the use of AI and also potential energy. So AI is really, really important, and there's a lot of companies, and we do think it's going to help software company, and we really like software companies because if they don't have to spend as much money on the hardware to have AI, then they'll make them more profitable.
The thing, I'm going to use an analogy here to think about when you think about whether it's AI or any of these other things. Let's go back to the automobile, right? The automobile was a luxury for many, many years. Only rich people had it. It was very expensive. And it was really only when Henry Ford came out with the Model T and they were able to lower the price of the automobile till everybody got that the entire industry really took off. And so when you look at innovation in technology, innovation that makes AI cheaper for the masses, what you're going to see is an overall increase in the industry, not necessarily a contraction. And so we're kind of excited about where this is. It'll be the democratization of AI, just like the Model T was the democratization.
You're gonna have robo taxis in June, supposedly.
Democratization of the automobile. This is a democratization of highly advanced technology.
Very good. I'm excited about potentially that robo taxi in June. That will be not to have a driver and drive you around. We'll see. All right. I think with that, we've covered quite a bit of things, and we will go ahead and we're gonna skip next month because it's a short month, and then the Fed does not meet till March 19th. So our next podcast is Thursday, March 20th. Please put it down from now. You will be getting the invitations when the time comes, and that by that time we think there's going to be a lot of changes. A lot will happen between now and then. And of course, if anything were to happen that needs for us to have a podcast before that, we will. But right now, this is our planning. I hope you like this new format of the video.
If you like, those of you who have watched the heard it versus have
saw it versus heard it.
Just let us know if you like. Let us know if you like this any better or worse.
If it's worth it.
Well, you always like to see Layla. I don't know that you like to see me that much, but everybody likes to see Layla. But at any rate,
I would like to see your new ties.
A different tie.
And your three-piece uniform.
Well, thank you very, very much. One thing that I will say is
Happy New Year.
Is a Happy New Year, of course, but also by the time we get to March and then luncheon in April, you'll have a very clean view of a very rapid and intensive legislative agenda coming out from the president. I think people are recognizing how quickly they're going to move. So pretty much the entire agenda will probably be already in Congress by the time we get to March. So make sure you turn in. Then we will have parsed everything and have a good view on what that's going to do. It's certainly a pro-growth strategy, and I think that's going to move well for the economy as we go through it.
Layla Pence is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Dryden Pence is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. The financial professionals affiliated with PWM are registered representatives with and securities and investment advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Pence Wealth Management PWM and LPL Financial are separate entities.